In this video, we will look at the bearish engulfing pattern. We had already looked at the bullish engulfing pattern. This is just a replica or the mirror image of that, but in the other direction. So this is a daily time frame chart of Intel Corporation. And if you see these two candles, that's the bearish engulfing pattern. So let's try to understand how to identify that pattern. So the first condition is it must come after a uptrend. That's condition number one. Condition number two is the first candle of the bearish engulfing pattern, which is a two candle pattern. The first candle should be a small real body. The real body of that candle should be as small as possible. The third condition is the second candle must be a tall black real body or the tall red real body. Okay. Fourth condition is the second candle real body must completely engulf the first candle real body. The fifth condition is both should be opposite in color. So it should be green and red or white or black. Black means bearish. Okay. Sixth condition is the shadows do not matter. Okay. The shadows can be anything. It can be long or small. But the important thing is the second candle should completely engulf. The second candle real body should completely engulf the first candle real body. Okay. So this is how you identify a bearish engulfing pattern. It is a two candle bearish reversal pattern. Reversal means after this pattern, the price is either likely to go flat or sideways. The chances that the price will go up from here is very low. Trading is all about the game of probabilities. Another point to mention here is that the high of the pattern becomes resistance. So if you were to take a trade, so for example, if you were to enter here, want to go short, then your stop loss should be here because that becomes resistance. And then you can expect the price to go down. Maybe look at that support level, this support level. Okay. That's a poor reward to risk trade, but that's how you would look at the bearish engulfing pattern. You would want the shadows to be smaller because if the shadow would have been smaller, then your risk would have been lower. The distance between entry and stop loss would have been lower. But that's how the bearish engulfing pattern looks like. Very strong bearish reversal pattern. How can you use it? You can either use it to initiate short positions, or if you are long, let's say you bought the stock somewhere here and you see something like this happening in the market, it is better you take a full exit from the market or at least take a partial exit from the market because this is a dangerous pattern. And if you don't do that, this is what happens. Look how the price collapses. So when you see this pattern, you have to act. Either you take a short position if you like to trade trade on the bearish side, or if you are already long, then you have to take some cards off the table. Okay. So that's the bearish engulfing pattern for you. Remember the conditions that I mentioned. Shadows do not matter. This pattern I have discussed in detail in level 1 of my Japanese candlesticks trading mastery program, which is available on this link. Check it out. You will learn this pattern in much more detail. Here, this pattern is not confirming any prior resistance, but the probability that the pattern will work greatly enhances if it confirms some prior resistance.